Good morning, everyone. I sincerely apologize for the late, for starting very late. Okay, let's quickly go. In our last discussion, in our last classes, we've actually discussed about group accounts, and we've learned everything on group accounts, starting from how starting from the acquisition and a parent company acquired the subsidiary company, investment in associates, and the rest. And this morning, I would like to conclude on what we've started on group account statement of financial position. And then I will now go to today's topic. I will now go to another topic, which is like, I actually call the topic a bonus topic, though, because it is where you should actually get your full mark for a bonus. Actually, for financial reporting, you should have nothing to fear. Just like my boss said, the basic foundation of success for financial reporting is just for you to practice question and use whatever we are giving to you. See, let me make this assurance again that yes, you can practice study pack, but actually follow what you were given first before you can now say you want to practice question pack. I will tell you that if you are able to go through all what we are discussing here, then your success is guaranteed. Everything you ever needed has been embedded in your study. Just ensure that you go through them. Both the pack, the pathfinder, all the questions that I'm giving to you are likely examination question. I'm not promising you that we get 100% seat as it comes in the examination, but if you don't get the actual question in your examination, you're going to have a likely question that will show you the way to do it. That is absolutely what you're given to you. Okay, let's get started. I don't like talking much. I like practicing. All right. Permit me to, you will see that today I call it quick refreshment. If you look at today's slide, I call it quick refreshment. Though it might be a refreshment, but let me tell you that it's not actually a refreshment. It's a question entirely from all what we have been doing. I'm even looking at the question with a lot of little challenges, and I want you to go through it so that you could see another way you can solve a questions, especially what we've done so far. We've not actually done the one that have investment in associates. We only discuss associates separately, and we discuss parent and subsidiary separately. But now let me merge the three. And after merging the three, then we can go to the new topic. I believe that the knowledge of this will give you and open your eyes to whatever you want to do. And aside from this, we are also going to look at statement of profit and loss. Okay, let's get started. The video, as you can see from your screen. The statement of financial position of three entities, they, V, and Do, are shown below. As at the 31st of December, year 5. However, the statement of financial position of Day records its investment in entity Do incorrectly. The investment in Do is shown at cost instead of in accordance with equity method of accounting and the requirement of IAS 28. I think I personally emphasized on this IAS 28 when we are discussing investment in associate. If not because of the time, I would have said, let me still ask you, what method does IAS 28 ask us to use? But let me read your mind. I can see somebody saying this equity method, right? Yes, fine, absolutely. That's it. IAS 28 asks us to use an equity method of accounting when we are accounting for investment in associate. And how does the equity method of accounting, what does it say? How does it go? It's just showing the consideration transfer, the amount invested in that subsidiary entity, then calculate the shares of profit. If there's any transaction that goes in between your one entity to that associate company, it must be recognized. If there's any other impairment, the impairment should be taken as 100% full impairment because it is an associate. That is what an equity method actually says. An equity method actually favors proportionate of shares. That is when you're calculating, you just have to calculate the percentage of holdings in that investment company. I hope I'm able to refresh you on what IAS 28 investment in associates states. Now, let's go into the question. The video, as you can see, Yeah, because the video is a gang of $1 billion. That is why it is in dollar. We have now current asset of the video, which is PPE investment in V at cost and investment in DO at cost, 320, 140 respectively. When you're not given the cost of acquisition, I think you all know how to calculate that, right? We've discussed everything in our previous slide, in our previous class. Okay, our current assets includes inventory, current assets with D, and current account with DO. Then we have other current assets, and our total assets equals this. All right. Our equities and shares comprises of all what we are given. Permit me to jump to the one that actually calls attention, additional information. Are you there? Additional information 1 states they bought 150,000 shares in subsidiaries several years ago when the fair value of the net asset of B was what? 340,000 naira. They bought 150,000 shares in V several years ago when the fair value of the net asset of V was what? 340,000 naira. I hope it splashes your mind too, as I've circled it. They also bought 30,000 shares in DO several years ago when the fair value of those net assets was $370,000. There has been no change in the issue share capital or share premium of either V or DO since they acquire its shares in them. Additional working note 4. There has been impairment. There has been impairment of $20,000 in the goodwill relating to the investment in V, but no impairment in the value of the investment in DO. At 31st of December of that year 5, DO owes inventory purchased during the year from D, which is valued at $16,000, and they holds inventory purchased from V, which is valued at $40,000. Sales from D to DO and from V to D are priced at a markup of 1/3 on cost. None of the entities has paid a dividend during the year, and they uses the partial goodwill method to account for goodwill, and no goodwill is attributed to the non-controlling interest in V. My dear professionals, you are required to prepare the consolidated statement of financial position of the group as at 31st of December year 5. I would have loved to ask questions, but because of time, let me remind us of what we've discussed earlier. Your working note 5 is on what? Intra-group transactions, which was treated last week, if you remembered. And we talk on markup and margin. Can I hear somebody saying that margin is equals to what? I mean markup. That markup is equals to the margin rate, or let me say percentage over percentage plus what? 100. Is that not? And remember that I said it is possible for you to be given in fraction. Where you are given in fraction is numerator divided by the denominator plus the numerator. Yes, we have it here. Unrealized profit on inventory equals to margin multiplied by value of unsold goods. You all know that already. But where markup is given, which is this question, that is the main essence of bringing out the question. Note that where markup is given, we will convert the markup to what? Margin before we calculate the unrealized profit on inventory. Are you linking it? Yes. I said if you're given the markup in percentage, for instance, 25 over 100, that your margin will be 25 over 100 plus what? 25, which will give you 25 over 125. And I said, where markup is given in fraction, here I use this examples of what? I use the sample of 2 over 5. I said the margin would be what? That the margin will be 2 over 5 plus the numerator, which is 2, so that it will give us 2 over 7. Do you remember? You get this properly? Let's go back to the question. So if I were you, working at 5 says, the holds inventory purchased from the year from day, which is valued at what? $16,000. Remember that your unrealized profit is equals to your margin multiplied by your what? Unsold goods. That is what I mean by value of unsold goods. Margin multiplied by unsold goods. Your attention should not be on what was sold, but what remained unsold. I hope you can get it clearly. Your attention, let me speak grammar so that we get it right. What you are looking for is not it's not what the person said. It is what remained that the person did not sell. Did you get that? The value that remained that we didn't sell, that we are unable to sell, is what we call unsold goods. So you are not looking for what the person has sold, what the person said. You are not looking at that. It's what remains in that person's shop, what remains with that person that the person has not sold. That is what you are looking for. That is what we call unsold goods. So when you look at the question, if you are given the value that was sold, you will now read further in order to get the value that remain what? Unsold. Look at this question. The holds inventory purchased during the year from day, which is valued at what? $16,000. And they hold inventory purchased from V, which is valued at what? $40,000. So sales from day to day and from V to day is at the markup of what? 1/3. Markup of 1/3. Convert that markup to margin. Just say markup to margin. This is working out equals to 1/3. Now give you 1/3 plus 1. And this will give you 1/4. You already know this 1/4. Just say times and hold on. Is that taken? All right. Which other one? Yes. How do you calculate the percentage of shares that the parent is having in subsidiary? It's left for you. In our last class, I told us that it is investment multiplied by the total numbers of shares in the subsidiary. Let's look at it. They. Apology for emphasizing on the question. The reason for doing so is because if you understand this question alongside with the previous discussion, my dear, you are very much okay in anything called consolidation. I repeat, if you get this question right, along with the previous discussions, my dear, you are fine in anything called consolidation. The only challenges you may be having is your additional information, which is a working note. And if you calm down, you read the additional information clearly, my own question should be, where is this thing going? And that is what you should start asking yourself. If you start asking yourself that, where is this thing going? Then you are fine. We've had a student that blasted 100 in FR. Yes, your account must balance. So this is KISS level. Your account must balance. My boss was telling you that it is the understanding that matters and not la Paul. That is, understand what you are doing. Don't cram. If you cram and something just changes, it will scatter all what you've crammed. And that is why we are here for you. Please get it. You keep emphasizing anything that you did not get. Please drop it on the platform and your question will be answered. And I think I've never seen a question that goes unanswered. Please. So that bought 150,000 shares. What is the shares bought? 150,000. So the solution is there. This is equity and liabilities. Equities and reserves. Equity of ₦1 each. This is equity of what? 200. Which one is subsidiary? Because you have to be looking at that. This is subsidiary of D in V. This is also in Do. Okay. D2, that also bought 30,000 shares also in Do, which means you can see that the shares that is having is not only with one person again. It's having shares with V. It's also having shares in what? Do. It has becomes what? Two persons. What is the first thing that comes to your mind? Do your group structure. Your group structure will tell you, will show you how those investment is. Well, then what is the percentage of that shares that is having? Now let's get started. Here it is. Can you see? That is having investment. I want to draw it so that you can see it clearly. That is having investment. This is group structure. This is the group structure. While you are working, make your work easier. This is that. I think during our basic consolidation, I said this, that whatever you want to do, your group structure should look like that of vertical. So that I said, don't use horizontal. This is horizontal. Don't use horizontal. Please use vertical. Why am I saying you should use vertical? Is that if you have more than one investment, it would make it easier for you. That, let's assume that this is the only one that I have. So that is having investment in V. Is that not? It's having investment in V. As that is having investment in V, it's also having investment in what? It's having investment in V and it's also having investment in Do. Is that taken? As you can see, when I draw it vertical, I can easily move either like this, or even like this. It's because I have it vertical. So do not forget. Now, what is the percentage of shares of that in Do? What is the percentage of shares of that in V? You now look at the shares that is being acquired. Let's go back to the questions again. Can you see? That acquires, that bought 150 shares in V several years ago when the fair value of the asset was what? 340,000 naira. This 340, leave it first. What is the shares bought? It bought 150,000 shares. Out of what is the shares in V? The second column is V. The first column is Do. This is the V Do. Equity shares at $1 is what? For that is 100. For the V is 200. For Do is 100. Okay. Now shares bought 150. Out of what? out of 200 shares. Punch your calculator. What will that give us? I've warned us that when you are coming to this FR class, you should always come with your calculator. I think you remember that, right? Okay, if you punch your calculator, 150 divided by 200, you can multiply it by 100. It should give you what? 0.75. Is that what you get? I can see somebody saying yes. Yes, it will give you 75%. I can see somebody saying yes. It's not taking. This one does not require formula. That is why I did not use formula. As you can see, it does not require formula. But shares, what is the shares bought? Ask yourself, he bought 150,000. Get it right, too. This is 150,000 shares bought. Out of what is the total shares of that subsidiary, which is V? You now go to your statement of financial position, where you are having equities and shares. What is the shares of V? 200,000. Just write 150 divided by 200,000. Punch your calculator. 150 over 200 will give you what? 0.75. 0.75 is 75%. If you are not clear, multiply it by 100, then it will give you your 75%. Just like that. Yes, you don't need formula. Even in the examination, you don't have to write how you get your percentage. So far, you can draw your group structure. Under a group structure, you can just put it like this. You can just put it like this. You can say he bought in V, he bought 15,000 shares out of 200,000. And that gives you what? 75%. Then your NCI at what? 25%. Like that. Why is NCI 25%? I've told you that 100 minus percentage acquired. Okay? Your NCI, for the purpose of those that are just joining us, your NCI is 100% minus the percentage acquired, which is what? 75%. And that will give you 25%. NCI means non-controlling interest. Those shares that were not bought. I hope that is clear. This is the in V. This is D in V. Now, what is D in Do? You now look for D in Do. What is D in Do? D in Do will also be what is the shares acquired? No formula required. They bought 30,000 shares. Your concern is the shares bought, which is what? 30,000 naira. Just write $30,000 divided by what is the shares of Do? The shares of Do has been given as what? 100,000. So 30,000 divided by 100,000, then multiply by 100 if you want to multiply it. If you check your 30 divided by 100, punch your calculator, it should give you 0.30 or 30% is the same thing. I hope that is clear. I haven't done your group structure. That is how you have 30% of D in V and D in Do is 30%. You can see it very clearly, illustrating. Fine. If you can do it like this, my dear, you've got your mark. Yeah, don't mind my unrealized profit that I brought here. Because there was no space to put it. That's why I just put it there for you so that you can see. Because it's the one that we're going to calculate under your 2. Okay. So you've done working note 1. You've done working note 2. Working note 3 now said there has been no change in issued share capital or issued share premium in either V, Do, or D since they acquired them. Let's go back to our 7 ethical rules of consolidations. When we say ethical rules, it means what is required for you to follow for you not to have issues. When we say ethical, it means what is acceptable. If you didn't use it, you might have issue. Use it, you don't have issue. That is what we're telling you here. You get it, everything. Don't give yourself some hard work. Okay? The secret of hard work, the secret to success is shortcut. Secret to success is shortcut rather. What is the shortcut? Knowing the formula, knowing your way. When you know your way, then you are fine. Subscribe to our premium class and know your shortcut to success. You don't have to bother yourself. Tell your friends, let them subscribe too. That is the gift you can give them as a friendship. Our working notes 1 has always been what? Group structure, which we've done. Let's go to the working notes 2, which is what? Subsidiary adjusted retained earnings. But yeah, I won't use subsidiary adjusted retained earnings. I will just use adjusted retained earnings because it is not just one subsidiary again. Is that taken? Remembered. You will see that I keep using remembered. Those of you that were not in that class, our first class, please go back to the previous slide. Go back to the previous lectures if you don't have requests. Please, because you need to get the basic so that it can pave your way. We said adjusted retained earning is mainly useful where there's a change in the figure that were given in the statement of financial position of that of the parent company. Like where there's unrealized profit, where there is pre-acquisition, either pre-acquisition retained earning or pre-acquisition profit. Is that taken? But in this case, it is unrealized profit. Yes, we have inventory of day. If you look at the questions, I said to convert markup to margin. Your unrealized profit should be margin multiplied by what? Unsold goods. Value of the goods that we are unable to sell. But in a situation where you are not given unsold goods, they just give you the total goods. What will you use? You use a markup. Oh my God. I hope you are enjoying it the way I'm also enjoying it. The explanation is real. Just listen, get it right. Your unrealized profit is margin multiplied by unsold goods. But where you are not given markup, where you are not given margin, you are given markup, you convert markup to margin. Where you are not given unsold goods, then you use your total value of the goods, your total goods value. That's what you use. Is that taken? Go back to the working note 5. Additional information 5, rather. It said, as at December 31st of that year 5, though holds inventory purchased during the year from Bay, and the inventory was valued at what? $16,000. We're supposed to be given the value of unsold or $4,000 instant. It's not a realistic instant. $10,000 of the inventory purchase remained unsold. If the question comes like that, you will use unrealized profit equals to margin multiplied by unsold goods. But in this situation, it is not like that. It just gives you the total value. Then in this situation, you will use markup equals to, unrealized profit, sorry. You use unrealized profit equals to markup times total sales. That's what you are using. It means you are grossing up. When you gross up, it means to add back in order to get the total value. Grossing up is to get the total value. We can also gross up from margin to markup. Don't forget, but we don't need that here. So also the one from day to V is valued as what? $40,000. And it says from day to day and from day to day, are priced at what? Are priced. You can see they are priced at a markup of 1/3 on cost. In fact, the question has even given you everything. Markup of 1/3 on cost. 1/3 on cost. This one will be 1/3. 1/3 is 1/3. Don't be too hard on yourself. 1/3. 1 is 1. Third is 3. You know that. Second is 2. Fourth is 4. Quadruple is 4. I think you know that. But here 1/3, it means 1/3 on cost. If it is on due, it will be on 16,000. If it is on day, it will be on 40,000. That is what on cost means. Okay, now we are doing more tori. Let's go. Inventory in due. Unrealized profit, just as I said, this is 1/3. Don't confuse yourself. $16,000 multiplied by 1/3, and it will give you 4,000 naira. You can check. If you have your calculator, you can just punch it in order to check. Okay. If you punch your calculator, it should give you the same thing. Are we together? So 1/3 on cost. And since it has already been priced on 1/3 on cost, just say 1/3 over 1/3. That's it. All right. Your 1/3 will give you 0.33333. Is that taking? Yeah. So that is that. Any question? 1/3 will give you 33.33. That's what 1/3 will give you. Let me break it down. Sorry, let me break it down for easy understanding. Sure. Yes, they said markup is 1/3 on cost. 1/3 on cost. Is that not what the markup says? Markup 1/3 on cost is the markup that we're given. So what is the percentage of the 1/3? Percentage of the 1/3 will give you 1/3 multiplied by what? 100. Is that taking 1/3 multiplied by 100? And this should give you, if you calculate it well, should give you 33 point. Let me stop at 33. Is that taking? To now get your value on sales. So your unrealized profit on sales now will now be margin multiplied by the value. So to just get the one that remain unrealized, value unrealized, to just get that, you just have your margin, which is 33.33. Remember what we said, over 100 plus 33.33. Is that taken? Then multiplied by the 16,000. It will give you the value unsold. I hope that is cleared. If you have 133.33 and you multiply it by 16,000, it should give you the value that remains unsold. And by my calculation here, I have 4,000 naira. So it means unrealized profit is on what? $4,000. I hope that is cleared. If you get it, please type yes. That is how I was able to get my $4,000 here and my $10,000 here. Okay. I have 1/3, 1/3 on cost. So 1/3 in percentage, 1/3 will give you 0.333. 1/3 will give you 0.333. Multiply it by 100 in order not to disturb yourself. Okay, just multiply it by 100. It will give you 33.333, as you can see it here. So 33.333 over 100 plus 33.333, it will give you 33.33 over 133.33. Then multiply by $16,000. You are fine. Is that taken? All right. Do the same for that too. The adjustment should be made to the post-acquisition profit, remember, of V and of DO. In addition, you also need the following. Reduce the investment in DO by the 30% of the 4,000. Don't worry about this one. This one, don't worry about it. Okay, don't worry about that. You will see it when we get there. So let's go to our adjustment in earnings since we've gotten our unrealized profit. You have as per statement of financial position, which is this. As per statement of our financial position, retained earnings to accumulated profit. Don't forget, you remember I told you that. So accumulated profit means retained earnings. I told us that it can be accumulated profit, it can be retained earnings. So for V is 140, for DO is 250,000. So look at that. For V, 140, for DO is 250. So remove the unrealized profit, the value of unsold, because they are the seller. Look at the questions. As at 31st of December, DO, which is the parent company, owes inventory purchased during the year from DA. DO is owing DA. Okay? DO holds inventory from DA, which is valued at 16,000. And they holds inventory purchased from what? V, which is valued at what? 40,000. So sales from day to DO, you see, sales from day to DO and from V to day are priced at markup. Is that taken? Stop. So that was how you have to adjust. That is why you need to adjust. You adjust for V, you adjust for DO. When you adjust, you have the 10,000 and the 4,000 calculated respectively will be 140 minus 10, then 250 minus 4. Is that taken? If the answer is yes, you go to the next one, which is subsidiaries net assets. For subsidiary net assets, remember what you call it? Subsidiary net asset. That one does not concern associates. Okay? Subsidiary net assets, you have DOC, you have DOA, and you have post-acquisition. This is part of our 7 rules of consolidation. Okay? Equity shares will give us 200,000. Go to the equity shares, is given already. I said it in my previous class that all what is under equity is what we called net assets acquired. All what is under equity is what we called net assets acquired. Okay? So for day, we have DOC, we have post-acquisition. For V, subsidiaries net assets means V net assets. Don't forget. V net assets. So equity share, I said DOC is the one as at what? The one as at the balance sheet date, which is statement of financial position date. So we are concentrating on V. All what is given here is called as at DOC. DOA can be gotten from what? Additional information. Is that taken? Go back to your questions. Equity shares at DOC is 200. Didn't change. So also 200. Go and check the share premium. Share premium is what? One is 80,000 naira. Share premium 80. But your retained earnings as a DOC, retained earnings should have been what? Retained earnings should have been what? 140,000 naira. Is that not so? But there's a question on it. Okay. Retained earning is 140,000, but I said there was a question on it. What was the question? What is the question rather? They bought 150 shares in V several years ago, when the fair value of the net asset of V was valued at what? When the net asset was valued at 340,000 naira. Is that taken? When it was valued at 340,000 naira. So the valuation was 340,000 naira. Oh, sorry. It should be a DOA. When it was acquired, it's DOA. So this should be 340,000 naira, not this. When it was valued at 340,000 naira, how will you now get the retained earnings as at then? Just walk back. Okay? You will just have to walk back. If you walk back, it will be, you know, this one. Let's assume that this one is not there. Let me prepare it for you from scratch. That is why I said, if you get this question, you are fine. If you have any question, you can quickly unmute yourself and ask. This is it. We are on subsidiaries net assets. Subsidiaries net assets. So for subsidiaries net assets, you have, where's the question? You have the retained earnings, net assets, you have the share capital. First of all, my DOC, my DOA, my post. You have your share capital. For the share capital, for V is what? Is 200,000 naira at DOA. 200,000. You have share premium.
Kí sílẹ̀ àbí? Àbí kí start àbí kí sílẹ̀. Okay.
Your share premium.
Hello, you are muted. I can't hear anything.
I can't see anything also. I don't know what's happening.
He's muted. He needs to unmute himself.
Apology. I don't know that I'm muted. I hope you can hear me now.
Yes, sir, we can hear you now. So
Okay,
please
thank
have to
God.
go over again. Thank you, sir.
All right, I will do that. I will do that. I'm very much sorry. Actually, I don't know that I'm muted. I apologize for the inconvenience. Did you get how we arrive at this retained earning at DOE? Okay, this is what I said. You add the equity share, you've already been given 200, 200. Share premium, 80, 80. But your retained earning for the DOC usually be what we are given in your balance sheet, known as SOFP. This is what you are given in SOFP, 140,000. But check, have you adjusted? If the answer is yes, this is what you've adjusted. You can see, that's why you call it adjusted retained earnings. Is that not what you call it? Since it is adjusted retained earning, you've adjusted it to be what? 130,000. So your retained earning as DOC here, your retained earning at DOC will be what? 130,000. Is that taking? Since that one is 130,000, you can quickly conclude on that. 200 plus 200 plus 80 plus 130 will give you everything in that, which is 410. This one will give you 410. Now, for the DOA, your equity share will still be the same. Share premium will be the same because we were told in the question that there has been no changes in the what? Issued share capital or share premium. So it means we are fine in that. Since there's no change in the issue share capital and share premium, nothing affects your share capital and share premium. It will be the same. But your retained earning, you will now go, you will check, was there any retained earning and acquisition? The answer is yes. We were told that they bought 150 shares in V several years ago, when the net asset of V was valued at fair value of what? $340,000. It means no matter what you are calculating, the net asset must not be greater than what? 340,000. So you just come and balance here, 340,000. Then what will now be your retained earning? Your retained earning will now be 340,000 minus this 280,000, which will be what? $60,000, which will be $60,000. And that is what I actually illustrated in my jotter here. As you can see my jotter, it is this 340,000, the 340 which they call the valuation. The net asset was valued at 340,000 minus the share capital of 200,000 minus the share premium of 80,000. So my retained earning at DOA will now be what? 340 minus this, which is what? $60,000. I hope we are fine with that. If we are fine, then let's go to the next one. Remember, I said if you can solve this question, you are fine with the rest. I hope that is what I said from the beginning. You can see that the question is somehow logical. Yes, but the ability to pay attention to what we're doing will pave way. That's why I said go back to the previous class and ask questions. All right, subsidiaries net asset done dusted. And the next one is calculation of goodwill. Which of the goodwill are you calculating? You can only calculate the goodwill of the one of your subsidiary, except where your investment in associate changes, and that is not for you, the financial reporting class. Okay, let's go to the calculation of goodwill. I hope you all know how to calculate the goodwill now. For the goodwill calculation, you have the amount transferred. What is the amount transferred? How much did you pay? That is your investment in V. That's where you get the consideration transfer. Investment in V is what? 320,000 naira. That is our 320,000 naira. Add NCI value at DOA. How does the group policy value their NCI? How do they value goodwill? That uses partial goodwill method. You know partial goodwill method. When they use partial goodwill method, it means that is how it has been valued. And no goodwill is attributable to the NCI interest in V. You can see. So it means when they use this partial goodwill, or it is the group policy to value NCI as proportionate or as partial, you are using the percentage on the what net assets acquired. So the NCI value at DOA is, this is, where is that NCI? This is value at our DOA. That is why you are calculating the subsidiaries net asset. This is value at DOA. DOA is 340,000. So just come, go to NCI value at DOA. Remember that our NCI is what? 25%, and parents acquire 75%. So it will be 25% on $340,000, which will give us 85. Then when you add 320 to 85, you will get what you called purchase consideration. Then less your net asset of the subsidiary. This is the subsidiary net asset. You will less it. If you deduct it, 405 minus 340, you will have your what? $65,000. But something also happened over the period. We were told that there has been impairment of what? $20,000 in the goodwill relating to the investment in V, which means V goodwill is impaired by what? $20,000, but no impairment in the value of the investment in DOG. Okay, so in valuation of the goodwill, you have to remove the impairment. Impairment, which is given, is 20,000. So remove 65 from 20,000. It means we are having a positive goodwill of $45,000. Okay.
Sorry.
Yes, I've done that. Yes, sir. Can I?
Yes.
All right. So having gotten your goodwill, the next one now is to do NCI calculations. For the NCI calculation, you've already done the job. Don't bother yourself much. NCI value at DOE. That is what you've calculated there. Post-acquisition profit. What is the post-acquisition here? 130 minus 60, you can see post-acquisition is 70. That's your post-acquisition. This post-acquisition will be shared between what? Parent and subsidiary. That is what post-acquisition means. You will share it between what? Parent and subsidiary, because they are the two involved. Parent will be sharing 75% of 70,000, and subsidiary will be sharing 25% of the 70,000. Okay, 25% of the 70,000. All right. That is why we have 25% of 70,000, give us 17,500 plus NCI value at DOA, we are having 102,500. Go to your consolidated retained earning, which is the sixth item. Consolidated retained earning is all about the parent company. And remember, it's having investment in subsidiary and it's also having investment in associate. You have to consolidate. So what is the retained earning of the parent first? The one that wants to receive all the visitor consolidation. Retained earnings of the subsidiary, this is retained earning of the parent company. Retained earning of the parent company is 650,000. So you add 650,000. Add parent shares of profit. Post-acquisition profit is 70,000. So you have 75% of that 70, which will give you 52,500. Then associate. Remember that is having 30% investment in associate. Since it's having 30% investment in associate, it will be 30% over multiplied by the associate retained earnings. Okay, so that is how we arrive at our 96,000, our 30,000 multiplied by 96,000 naira. I hope that is cleared. Okay. Yes. Having said that, since you've calculated your share of associate, you've calculated your share of profit, then under the retained earning, you have to also remove the impairment. Remember that you've removed the impairment from the subsidiary. This is it. You've left it from the goodwill of the subsidiary. Then you also have to remove the impairment from that of the parent company too. So the impairment of the 100% will give you what? 20,000 naira. If you consolidate it, you have 711,300. Having done consolidated retained earning, then the next thing is go for investment in associate. But this investment in associate, you can first of, if you like, you can first of all do investment in associate, because that is what I've done here. For my investment in associate, the first thing is consideration transferred, which is consideration transferred, investment in DO. I said this is parent, this is parent, this is subsidiary, and this is what? Associate. Okay. For the associate, investment in associate is 140,000. You will have investment in associate 140,000 naira, $140,000. Investment in associate $140,000. Then share of post-acquisition profit. Because I don't know share of post-acquisition profit yet, I say I have 30% times, then I hold on to prepare associate net assets. For the associate net asset, it's just the same thing like subsidiaries net asset. You have your DOC, you have your DOA, you have a post-acquisition. There's no changes in share capital, remember. So equity share of associate, this is the equity share of associate, 100 and 120 respectively. So that is how we have our 100, 120 respectively. Okay. Retained earnings of the associate as at date of consolidation. Go there, you will see it. Retained earning as at date of consolidation is 250,000, right? But hold on, go and check for the adjustment. But before that, they bought 30,000 shares in those several years ago, when the fair value of those net assets was what? 370,000. So retained earning as a DOA is what? 370,000. So this is the 370,000. The retained earnings that were given. The retained earnings that were given as a DOA is 370. You already have the 370,000 naira. Is that taken? That's the 370. And whatever that might happen, look, is there any investment? Go back there. There has been no changes in the issue share capital. Although for the issue share capital of D, DO, and V. But there has been impairment, yes, that one is clear. As at the year 5, DO holds investment in, DO owns inventory purchased during the year. So there is a retained earnings adjustment for DO. You can see it. Retained earning adjustment for the DO. DO is the associate. We adjusted the retained earning. So this is what you are using as at the closing balance. You have 246, retained earning as at DOC 246. That's what you adjusted for. As a DOA, you are given when the retained earning was this. When the retained earnings, they bought 30,000 shares several years ago when the fair value of DO net assets was 370. The fair value was 370,000. So here you'll be having your 370,000. But before that, what is the retained earning? Go back to the question to first of all see your retained earnings. Okay. So this is the questions. The retained earnings as at DOA, accumulated profit retained earnings is 250,000. Oh, sorry. It's 250,000. It was when it was adjusted that it gives us that. So go back to your working note. 250,000 naira. Do we get that? So between the same way that we've done this, the same way that we've calculated the subsidiaries net assets of 340 minus 200 minus 80, that retains earning give you 60,000 naira. Do the same thing for that of the subsidiaries. Is that taking? Do the same thing for the subsidiaries. If you do the same thing for the subsidiary, whatever you get is you will have a value of 150 left. 370 minus 100 minus 120 minus 100 will give you 150. Because we have already been told that the net asset as at DOA, it is 370,000 naira. If you will do that, you will have just have your 370 minus 100 minus 120 minus 100. It will give you what? 150,000 naira. This 150,000 is what we valued as a what? Retained earning as at opening. So 246 minus 150 will give you post-acquisition profit of 96,000 naira. It is this post-acquisition profit of 96,000 that you are going to share your share of profit to the parent company, known as D. And 30% of 96, if you punch your calculator, will give you 28,800. I hope that is taken. All right. Having done that, we are done with all the necessary adjustments. And the next thing for us is just to consolidate, just as we can see on our screen. To consolidate, you have PPE. You are not consolidating that of the subsidiary. Subsidiary is to account for it, account for the investment using equity method, which is this. This is the equity method of IAS 28. This is what has not been accounted for. Go back to your question to get it right. I repeat from the beginning. The statement of financial position of the three companies, the VDO, are shown below. However, the investment in DO is shown at cost. The investment is shown at what? At cost. Instead of what? As at equity method of IAS 28. Though investment in associate can be treated as cost and equity method, but IAS 28 favors equity method. I emphasize on that. Do we get that? It's because of we are told that it is treated at cost, and we have to take it back to what? As what do we call it? You have to take it back to equity method, and this is the equity method. Equity method, I still said it during the beginning of this class, that it is your consideration transferred, then find your share of profit. If there's any impairment related to associate, impair it 100%, and if it is not, leave it. Don't bother yourself. If it is not, leave it. I hope that is cleared. If that is cleared, then let's consolidate. You are not consolidating the associate. What you are consolidating is between D and V. So you start from your PPE. PPE is 450 plus 250. This one is cancelled. This one is cancelled. Those two investments is cancelled. You have investment, you have PPE, then it should have goodwill. But investment in associates, you will still recognize it, which is investment in DO. But that one has already been adjusted. Don't forget. That is how we have PPE, 450 plus 240. We've done basic consolidation before. We have 690. Then investment in associates. What is our investment in associates? This is it. 168,800. After that, you have your goodwill, working note 4. Your goodwill in working note 4, which is 45,000 naira, you will have to add it. Having done that, then the next one is what? You go to current asset. Your current asset, remember that the 10,000 naira have to be deducted from your inventory, because it is inventory that were unsold, that were unrealized rather. So you have 70 plus 90. This is parent, this is subsidiary minus the 10,000. Then your other current asset must be added. I haven't done that. This is current asset. We are adding these two. Okay. Other current assets is this plus this plus this. Other current asset. Current asset means current asset is like an account you have with that company. Is that taking? Just like a bank, you now have another company there. That is what we call current account. So your current account, you added it, you consolidate your current account. When you total it, your total asset is giving us 1,313,800. Then go to equity shares. Equity shares, this is parent company alone. Parent alone, I told us, because that of the subsidiary and the distinct, we've done that already. So this is parent alone. Share premium, parent alone. Retained earnings, your working note 6. If you check your retained earning at working note 6, working note 6 retained earning, you can see 711,300. Retained earnings 711,300. Non-controlling interest, NCI, that you've calculated your working note 5, 102,500. Is that taken? Then your long-term liability, your current liability, and your account balance as usual. So that is how to prepare the account of the VDO. Any questions? Do we all get that? If you have any question, please submit yourself, because to me, we have come to the end of anything called group statement of financial position. The only thing that I can treat with you next is statement of profit or loss. This one has included associate. Doing that statement of profit or loss to another comprehensive income, though we will still prepare our SOFP, and then I will also be discussing subsidiary with you, but this is just everything you need to know under group accounts. And this is another phase of question that you can see that is quite different from those ones that has already been treated earlier. Any question, please? You can unmute yourself and ask. You can unmute yourself and ask.
So you guys, if you have any question, kindly unmute yourself and ask the question, or you can simply send it to the chat. Okay, so if you don't have any question, kindly type no in the chat, or kindly unmute yourself and say no, so that you are sure that you are following the class. IK, Karen, Salabi, Uche, Wasil, any questions? Send no to the chat or unmute yourself and say no. Can you guys hear me? Okay, no questions, sir. Okay.
All right. Okay. Since no question, join me as we shall be discussing IAS 7, statement of cash flow. IAS 7, statement of cash flow. When we say cash flow is just the movement of funds. Cash flow is just a movement of funds. So statement of cash flow is your IAS 7, and IAS 7, like I said earlier, is just a bonus mark, but you also have to follow the rule. Everything, most things in account is to follow the rule. Statement of cash flow is an important component of the financial statement as it records the cash inflows and outflows of an organization. When you ask me, I will tell you that cash flow statement is the inflow and outflow of cash and cash equivalent as at the end of the period. Okay? IAS 7, statement of cash flow, analyze the activities of business entity into 3 main groups. And the 3 main groups are operating, investing, and financing. And it also tracks the cash flow position of the business entity. When we say a cash flow statement, it's very useful to the financial statement as it provides information to users of financial statement about the entity's ability to generate cash and cash equivalents, as well as is indicating the cash needed by the entity. That's how we say cash inflow and outflow. Inflow is money that comes in. Okay? Cash received. Any cash that you received, you call it inflow. This is a general English term. Outflow is cash give out or cash given. Any cash that you give out or that is given out is known as what? Outflow. Okay? When you give out, part of payment is give out. Or give out is part of payment, or part of payment. Okay? Now, you shall understand. If you make payment, you are giving out. So the only limitation to this IAS 7 statement of cash flow is that it is prepared based on historical information and doesn't provide complete information for assessing the future cash flow. Basically, this standard actually states 3 activities, as I've told you earlier. So let me take that activities one after the other because of time. Operating activities is the first one. Investing activities is the second one. Financing activities is the third one. I'm permitted to take it one after the other. When we say operating, see, let me come again. Don't be too hard on yourself. I keep telling you that in my class because you can get everything as easy as anything when you pay attention. When we say operating activities, if you remember, your statement of our financial statement, basically, it is statement of profit or loss, and then statement of financial position. What am I saying? Profit or loss account and balance sheet is what you call financial statement mostly. Under our statement of profit or loss, you have some activities before gross profit. That from gross profit upward is what is known as operating activities, because they are the activities that you generated from your normal course of business transactions. Your activities from your normal business transactions of your business activities, your day-to-day running of the business, it's what you will be accounted for under your what? Gross profit. And they include what? Your sales and your cost of sales. The same thing. The same thing for cash flow statement. That's why operating activities are those inflows or outflows that relate to the business operations. They are the principal revenue producing activities of the entity. They are the major things that generate money for the companies. Operating activities. Without operation, no organization. Then what are the operations? Operations are the running of the business. That's what I want us to get. It deals with the company's normal operation, like what? Selling of goods, purchase of materials, payment to suppliers, what you receive from your customers, what you are giving out on credit that you did not collect money, payment of salaries to your staff, etc. These are what we call operating activities. But your financing activities are those activities that relate to the cash flows of the business investment. It relates to the investment decision of the business. That is, what do we call it? We call it investing. Let me say investing is when you use your money either to buy an items that will be generating money for you, or you put your money in another place to be generating money for you. You call it investing. For example, most of us have investment. What is investment? When you buy shares from companies, you've invested in that companies. When you try to buy some of the equipment you need to use for your business, it is called investing. What you are doing now is called investment. You are investing in your career by subscribing to our what? By subscribing to our virtual class. That is what? Investment. When you subscribe, you are investing in yourself. That investment is also an asset. Is that taking? Remember that when you pay money to ICANN, you invest in your career. After the payment for your exam, ICANN will give you study pack. If you set that study pack, it is also part of what? Investment. Is that taking? So when we say investing activities in a nutshell, we mean when you buy or you sell part of your what? Asset. Those assets to business might be PPE, it might be purchase of subsidiary, it might be investing in a company. But let us know that they are those activities that bring money into the organization. But when you invest, remember that you are giving out. You might think you are wasting money or losing money. You are only giving out. After you qualify as a chartered accountant, if your salary before is 30,000, my dear, 300,000, 250 minimum. But don't be a quack scattered accountant. A scattered accountant is the chartered accountant without knowledge of accounting. By now, your priority as an ICANN student should be in audit firm if you are not working yet. And if you are working, just ensure that where you are working is accounting related. Okay? So that is that for investing activities. For your financing activities are those activities for expansion of the business, such as what? When you issue shares, you are inviting people to come and subscribe to your shares so that you can what? You can expand. When you redeem shares, you are also what? Expanding. Those expansions are what is known as your financing activities. And this financing can be gotten from your what? Balance sheet. If you look at your balance sheet, just go to your finance by. Go to your statement of financial position, go to your finance by. When you go to your finance by, you will see where we are having all this issue of shares, share premium, and the rest. Those are what we call financing activities. Is that taken? Have a look at the three categories of cash flow, which is operating, investing, financing. Let's discuss. Note that interest paid can be under operating or financing activities depending on the sources. Interest paid is one of the challenges that we usually have when it comes to this. Remember that we have financing, we have investment, and we also have operating. But if it is interest paid, it depends on the types of the interest that you paid. If you paid interest on the loan you issue to people, that one is under financing. But if you paid interest on the loan you collected, that one is called what? Operating. Okay. Sorry, if it is on loan, it is still financing. But if it is on short-term loan, that's not a long-term loan, that one is operating. If it is on overdraft, that one is also what? Operating. What is short-term loan? Short-term loans are those loans that is available for a petty trader that you can use to run your business, which does not last more than one accounting period, 1 year. Long-term loans are those loans that you can use for like 5 years, 3 years, 10 years. That one is financing because you'll be paying interest to those people. But for the short-term loan, they are the loan that we just get and returned immediately, usually after a year. Is that taking? That one is what? That one is operating. Know when to use operating and know when to use financing. A question I want to scatter it to you. Okay, but me just know how to differentiate. Obviously, basically, there are two methods of preparing cash flow statement. which are what? Direct and indirect. You have your cash flow. Cash flow is divided into cash flow methods. Cash flow method is direct method and indirect method. Though I can have texted these two before, and at times they might decide. I can have texted these two before, and where the question is silent, use indirect. Okay, it is recommended. It is recommended that direct and indirect method. That is what IS 7 recommended. But it's recommended that direct method is preferred than indirect method. But in practice, IS 7 basically recommend direct method. But in practice, we preferred indirect method because of its simplicity. But the ability to use the two methods is what matters a lot. But when your examiner is silent, please use indirect. You see that I asterisk it. That's where your examiner is silent. What does examiner silent mean? Where nothing is mentioned as the method, use indirect. That will give you more mark, more distance. And it's easier. Though direct method is much easier, but there you'll be preparing your ledger account. I hope that is clear. But note that there's discrepancy in this as we use direct method in practice as well, but don't argue on this. Just follow the examiner's instruction or use what? Indirect. Why I said don't argue, I've actually seen in practice some we use direct. In practice, we use indirect. It depends on your firm and what your boss actually needs. But IS 7 just said it's either you use direct or indirect. And why I said do not argue is I don't want us to deliberate much on this. You will see some materials that will tell you use direct. Some textbooks will tell you no, it's indirect. Some will tell you direct, indirect. Some will tell you indirect, direct. No matter what they said, my dear, please stick to indirect method. But if the examiner said you should use direct, please use it. But if the examiner is silent, please use indirect. Okay? I hope with that you are able to grab something. If you don't understand, ask questions. Yes, it is my religion to usually give a shortcut to everything. That is why I said the secret to success is what? Shortcut. Don't forget, it is shortcut. Secret to success is shortcut. Yeah, I also have a shortcut for the statement of cash flow. Oh, time is just ticking fast too. Let me also tick fast. All right. For statement of cash flow, IAS 7 cash flow statement. I have a formula that I use, or let me call it a mnemonic. The mnemonic is, this is KISS level, is P deep diff. IRVIT. Sorry. Or is P deep IRPIT. Yes, let me use that. It is a mnemonic. Okay, mnemonic means abbreviation. This P, if you write, for instance, you write Ridwan statement of cash flows as at, don't write your at like that too, as at 31st of December 2000 and any year. Choose the year yourself and send your year to me. All right. So let's go. The first P is profit before tax. Profit before tax. Oh, because of time. The first P is profit before tax. Add the I already have it here for you. This is it. PIP dip, IRP, IP, IRT, IP, or IRP, IT, anyone you like. As you can see, the first one is profit before tax. Always use profit before tax. Profit before tax. Add what? Investment income. Add finance cost. When you add it, you will get, when you add it together, you will now have adjustment for non-cash item. Adjustment for non-cash items. What are the non-cash items? Items that they are not a cash, but there's a movement. And what are they? Depreciation, disposal of non-current assets, impairment loss, then provision. You ask me that, where is that my formula? This is the P, this is the I, this is the F, that is the first P. As you can see, that after that, I use hyphen. That hyphen is for us to know that there is a kind of subheadings for the one that is coming. And that another one is adjustments for non-cash item. Put adjustments for non-cash item. Then you have your depreciation, disposal. The depreciation is DIP, depreciation, disposal of NCI, impairment loss is the first I, provision is the P. Have you seen it? Having calculated that, you see hyphen. Because all what you are going to get here are called cash generated before changes in working capital. Before changes in working capital. After that, we now go to what? Changes in working capital. Changes in working capital. And what is changes in working capital? Inventory, this is the I. Receivables, if you have receivables, you might also have prepayment. Anyhow it comes. It's either receivable and prepayment or receivable alone. Okay. Then you have payable. That is the IRP. This thing is wrong. Go. This thing is wrong. Go. Is PIF DIP IRP IT. inventory, receivables, payables. Then after adding that, you will get your cash flows from operating activities. After getting your cash flows from operating activities, you will then add your what? You will then add your interest paid, tax paid. This interest paid, tax paid, that is the two, that is the IT that is there. Interest paid, tax paid. Okay, interest paid, tax paid. And after that, you are just been through with your what? With your net cash flows from operating activities. I haven't done that. The investing activities also have a method, but the one that also have a formula, not a method, also have its way, as well as financing. And that one is just proceed from sales of non-current assets, as I said. And if there's any purchase, either proceed or purchase or disposal, that is what they will use. Under financing, there might be a loan issue. We have loan issues, not loan issue, not issue like fighting, no. Issue as in issue, when you issued out. Then if you have a loan issue, there's tendency that you have a share premium, there's tendency you have dividend. If you have that one, you add it to it and you get net cash flows. Okay. First is the profit before tax. You can always see in your statement of profit or loss. This is the int. Int on solving statement of cash flow. Statement of cash flow is one of the interesting topics. And I'm imploring you to quickly go through it. Okay, because of time. Then make adjustment for non-cash item. Why? Because statement of profit or loss and statement of SFP, we are prepared on an accrual basis. So this basis always incorporate estimate, which are all financial reporting jargons. And such items are what? Depreciation. Okay. I said note that the examiner do hide depreciation for the year. Please look for it because it is almost impossible for an entity not to depreciate its asset during a year. Okay. I haven't done that. The next one is investment income. That one also have a little explanation. And that is where there's a fair value gain or gain and disposal, but I don't think they should ask that at this level. Okay. In summary, items to post under operating activities are cash items that the entity partake during the course of the business. This exclude the payment of loan, exclude. Okay. Example of such item are cash received from customers, cash paid to supplier, and the net is usually positive, but at times can be negative. Item to post under investing activities. Are you seeing it? Let me call this one 1. Let me call this one 2. Item to post under investment activities are capital projects, such as purchase of land and building. Machinery, disposal of item under PPE, etc. Okay. The next one is tax paid. In order to get the tax paid, at times, you might not be given in the question. you have to adjust. How do we adjust? You say opening balance minus or closing balance plus opening balance. Opening balance plus tax expense minus closing balance. Or you have closing balance minus opening balance plus tax. Anything that will give you is we call the tax paid. If you are to do the tax paid, is tax an income or liabilities? Okay, for investing activities, you have proceeds from sales of NCA, less acquisition of NCA, then add dividend or interest received. But for the finance cost, you have purchase from sales of shares, purchase from sales of the venture, redemption related, interest rate, you are paying it out. Okay. Also, we still need to look at how these how the fund are actually moving. All right. Having said that, let's quickly look at the question, Usman PLC. Are we still together? In a very short time, we are given the statement of profit and loss, and other comprehensive income of Usman PLC, as we can see. Additional information. Plant which had the carrying amount of 20,000 naira was sold for 20,000 naira. What happened? Cash and new equipment was purchased for 10 million naira. What happened? Okay. Intangibles valued at 30,000 naira were acquired for the cash. Borrowing of 20,000 naira cash were made during the year and received in cash. Dividend paid in cash amounted to 100,000. When you are working, when you get to all this payment, best thing, you can do your additional information down. And if you like, you can do it as part of your this thing. So that was still fair. All right, can you answer the question? Forget the B part that states that Usman PLC is seeking listing of his share on the floor of Nigerian Stock Exchange. Let's leave that. If you have time, we'll come back. And if you don't, we might continue from there in our next class. Okay. All right. If you look at these questions, said you are required to prepare statement of cash flow for Smart PLC for the year ended 31st of December 2013 in accordance with IAS 7 using what? Direct method. Very good. This one is on direct method. I see that the examiner actually stated there that using a direct method. So you have to use a direct method. What are the direct method? Any cash received or cash payment. Okay, yeah, let's get started. We have this statement of financial position. Where is the statement of comprehensive income? Okay, this is the statement of profit or loss. You have revenue, you have gross income, you have gain on sales of plants. Also, you are given your expenses. You have your profit before tax. You have your income tax expense and also the profit for the year. Okay. So for the A part, what are the cash received from customer? Go back there. Yes, or questions? You have revenue, depreciation of plant. You can see accounts receivable. Okay. Accounts receivable, you have 158, you have 140. Prepayment we are given, interest receivable you are given, up to. Then any additional information? No, for now. So you have your opening cash received from customer. Your opening cash received has already been given. Cash received from customer, where's our received? Account received. You can see this is last year. Last year, this is the current year. Last year will become opening. Don't forget. This one will become close. This is closed. Okay. Oh yeah, interest. Where's our cash received? Account receivable. For last year is 140. For this year is 158. What has happened? There has been a movement. There has been movement. Look at the question once again. Where's my pad? All right. This is the notepad. As at last year, it is 140,000. Current year, it is what? Hold on, let me check the question. So last year is 140,000, and this year so you can see last year is 140,000. This year is what? 158,000 naira. So you come here. Okay. So last year is 140, and this year it is 158. What has happened? Definitely there has been a movement. A movement of what? Cash paid. If it is the current year that is lesser. It should have been cash given out. Do we get that? This is it. You have the solution here in order not to waste much time. Opening balance, which is that 140,000. Add the revenue for the year, which is that 16. Revenue for the year. This is account receivable, 140. Revenue for the year. Revenue for the year is 16. Revenue for the year means what you received for that year. You have 140, you have 140,000, and you received 160 alongside. It will be 140, and is it 160 or 640? You receive 1.6. You have 140,000 and you receive 1,600,000 joined. And then as at the end of the day, you are now having what left? You are now having 158,000 naira left. What happens? There must be payment. If it reduce, payment. If it increase, money comes in. If it reduce, money goes out. That is what you are checking for. You are only interested in inflow and outflow. What comes in, what goes out. Okay? So if you look at it, 140, as I explained, 140, 1.6 equals to 1740. So what you are having left is what? 158. Definitely you've paid in what? You've paid the remaining balance is what? 1.582. This is what the total money that you received from the customers. I hope that is cleared. Receivables. Receivables is your customers, while payables is your suppliers. Where can I write it? Receivables. Receivable means customers. Okay. Payable or payables. Payable means suppliers. Payables are those people that are giving us goods to use. Receivables are those people that we are selling items to. So it means the total money we received over the period is 1,582,000. Okay, that is the money we received by cash. Go to the next item, should have been cash payment. The next item should have been cash payment or inventory. But since I've already chosen, I've taken receivable. Let me conclude it. The next one is interest receivable. Interest at the beginning of the year, interest at the beginning of the year, interest as at close, at the beginning, as at close, 200. So where is this 100 naira? Does it mean that it's 100 naira that I received? Go and look for where you can get interest receivable again, or there will be additional information to back it up. See now, you have interest income of 100,000 naira. Go and look at your additional information. Is there anything relating to that? The answer is no. So go to your workings. Opening balance, 300. Accrued interest income, 10,000. Deduct the closing balance of 200. Remember, then when we calculate it, it's 100 naira plus the interest income that we received, which is 10,000. So this will give us 10,100. We received it in you. Haven't calculate your cash receipt from customer. The next one is cash given. After cash received from customer, the next one is cash given out to what? Supplier. Okay. Let us use our notepad for better understanding. Remember that we said cash flow. We said cash flow as cash flow methods are divided into direct and indirect. That is what we said. It is divided into direct and indirect. For the direct method, the only differences between direct and indirect, I said it earlier, is just the operating income. Aside from that operating income, nothing differs. Everything the same. Okay? Aside from that, nothing differs. Every other things are the same. So for the direct method, the only thing you need there is cash receipt. This cash receipt is cash receipt from customer. Cash receipt from customer, and then cash payment or cash paid to suppliers. Is that taken? That is the only thing that we needed. Cash payment and cash received. Every other one is what you can actually get easily. Then if there's any interest on bank overdraft, if there's any distance on that, you will do it. Okay. So having said that, let's go back now because of the time. So we've calculated for the cash receipts, which include cash received from customer and the interest income. The next one is calculate for the payment. So to calculate for the payment, you still have to go back. Payment to supplier. Go back to your questions. This is account receivables. You can see prepayment. Prepayment is an advance payment. Account payable, 84 at the beginning, 90 at end. Did anything still occur during the middle of the year? You have to ask yourself. Okay. So without wasting time, opening balance 84, closing 90. Purchases during the year is 970. Everything, it means we are giving out 964,000 naira. Are we together? If the answer is yes, the next one is to calculate your purchases during the period. We are still under operating. To calculate for your purchases during the period, you will check for the purchases. This is a goods sold. It's an expenses. What of the purchases? You will have item purchased. Sorry, when you are working with, what is it called? When you are working with direct method, it is usually something of traces. And that is why majority does not like that of the direct method. And that's why some examiners do now prefer indirect method, because it makes students to actually search. Okay. All right. But where the information is not much, you can actually get everything you needed. So for the cash payment, you can see For the cash payment, go to your account payable. Account payable, I said 84 at the beginning, then 90 at end. Then purchases during the year. Then purchases during the year, 970,000. Where's your cost of goods sold? You can see it, 960. They must give us cost of the goods sold breakdown. In case where we are not given, then it has to be in the statement. Because part of the items is our what? Cost of goods sold. Is that taken? All right. So what is our cost of goods sold? We have 960,000 naira. So because of time, your 84,000 plus the 960 minus the 90, we have 964 that you are paying. This is how it is being adjusted. Cost of goods sold is 960,000. Add your closing inventory. When you want to get your purchases, you know how to get your purchases. If you want to walk back to get your purchases, remember that it is opening stock. It is opening stock. Add your what? Add purchases. If you add purchases, you will add carriage inward, less returns outward. Now less what? You will less closing stock. If you less closing stock, you will have your what? Cost of sales, known as cost of goods sold. So if you now want to get these purchases, it will be cost of sales. This one that you less, we add it back. So it will be, so your purchases will be cost of sales plus, this is working back, plus your what? Closing stock plus closing stock. It will give you a what? Purchases. But remember, purchases, you also add this one to it. So you will also have to less opening stock. Less opening stock. The value will give you your what? Your purchases over the period. Do we get that? That is how we are going to solve for this. So in a nutshell, you have your cost of sales, 960. Add back your closing stock. Then less your opening stock, just as I've shown you. So your purchases is what? 970. It is that 970 that we add to this opening stock for cash payment in order to get your what? Actual cash payment for the period. Haven't done that, do everything and come back to your statement of cash flow. So you have cash received from customer as given under working note 1. Add back cash payment to supplier. That one is in 3A. Cash payment on behalf of employee. That one is working note 4. Cash paid, interest paid. Remember that I said interest paid is 2. If it is an overdraft, that one is on operating. If it is on finance cost, that one is on what? That one is on finance cost. Is that taken? Please take note. All right. The interest paid for the operating activities is the one on the accrued interest. The one for the accrued interest is that of the what? This one, accrued interest, is finance cost. Finance cost, and the one for the operating is that of the interest payable. Interest payable. Take note of that. Please ensure you go through the slide and ask any questions where necessary at your convenience time. Okay, that is that on cash flow statement. In our next class, we shall re-examine another question on using indirect method of cash flow. I also look at one more questions on cash flow direct method, and with that, we'll put an end to our cash flow statement. Thank you. For the B part, which asks for IAS 24 related disclosure, we are going to discuss that. And my colleagues that is actually taking us standard will run us through on IAS 24 related party disclosure. Please feel free to ask questions. Feel free to ask questions on the slide on what we've discussed so far. Thank you for your time. Thank you for the attention. Thank you for listening. Thank you for walking through. Please, it does not end there. Go through all what we have discussed and ask questions. Go through all what we have discussed and ask questions. Okay, by asking questions, it will give us more advantage on whatever we do not understand. Please ask questions as at any point in time. Even after today, you can still ask questions, just drop it on the platform. Thank you for your time. Any question before you finally call it over? You can unmute yourself to ask questions.
Unmute yourself, or you can send a message to the chat. Okay, somebody is saying, I need today lecture notes. Yes, it will be sent to you. Don't worry. Don't worry, it's going to be sent. I'm going to send it. In fact, let me send it now. So what else? Will that be all? Are you guys okay with today's class? Let us know. Okay, I have sent today's notes to the WhatsApp class. So that will be all for today. Hope you enjoyed the class. So see you in the next class. The next class is audit and assurance. And I think Oluseyi Talabi, you are subscribed to that class. So I will send you the meeting ID and passcode for that class to the group very soon. So kindly join the class. Thank you, everybody. Do enjoy the rest of the day. Bye.